Let's talk about a retirement trap that catches so many people by surprise. Required minimum distributions, or RMDs. We're going to uncover how they can create some serious tax headaches even if you think you're doing everything right.
Okay, so let's start with a really common scenario. You're already pulling money out of your retirement accounts to live on, maybe even more than the minimum you think you need. So you can just ignore all those complicated RMD rules, right? I mean, it makes perfect sense.
Well, unfortunately, that's exactly where people get into trouble. That very logical assumption is a trap, and it can lead to some really expensive surprises when tax time rolls around. It's a classic case of what feels right actually costing you a lot of money.
To really understand why this is such a big deal, we need to take a quick look at how RMDs actually work behind the scenes. So let's get into it.
So, what is an RMD? Put simply, for all those years you were putting money into your traditional IRA and other pre-tax accounts, it was growing tax-deferred. Well, now Uncle Sam wants his cut. Starting at age 73, the IRS basically says, okay, it's time to start taking some of that money out, and that withdrawal counts as taxable income. And here's the thing, RMDs tend to snowball. As your account balance hopefully keeps growing, and as you get older, the percentage the IRS makes you take out goes up. You put those two things together, and what happens? Your mandatory taxable withdrawal gets bigger and bigger every single year.
And this right here is the absolute key to everything. It does not matter if you're taking out $50,000 for your living expenses when your official RMD is only $20,000. The IRS requires you to actually calculate the official RMD number every single year. You can't just skip that step. And ignoring that little piece of compliance is where the danger really starts.
So, you might be asking, what's the harm if I'm already taking the money out anyway? Well, let's look at 6 hidden dangers that can pop up and really hurt you, even if you think you're safe.
These things really compound on each other. Your IRA can grow into a massive tax bomb. The withdrawals can unexpectedly spike your Medicare premiums and even make more of your Social Security taxable. Bit by bit, you lose control over your own tax planning. You can miss the perfect window for smart moves like Roth conversions, and you could even pass a bigger tax bill onto your kids.
Let's just zoom in on one of these because it's a huge one that nobody ever sees coming. How RMDs can directly jack up your monthly Medicare premiums. This is a perfect example of a totally unexpected cost.
And we are not talking about pocket change here. A large RMD can easily push your income over a specific threshold, triggering what's called an IRMAA surcharge. This is a direct penalty that can cost you thousands more per year for the exact same Medicare coverage, all because you were forced to take a withdrawal from your IRA.
And this really gets to the core of the issue, which is a loss of control. You see, before you turn 73, you are in the driver's seat when it comes to your taxes. But as soon as RMDs begin, the IRS is essentially in the passenger seat telling you how much taxable income you must create, whether you need the money or not. All that flexibility you had, it's gone.
Okay, so that's the problem. And it is a very real and potentially very costly problem. The obvious question then is, what in the world can you do about it? How can you get back in the driver's seat and protect your hard-earned savings?
Well, the good news is you are not helpless here. There are some really powerful strategies you can use to get out ahead of this RMD risk. So let's look at some of those proactive solutions.
You really have two choices here. There's the no-action plan, which usually means just accepting higher taxes and those forced withdrawals later on. Or there's the proactive plan, which is all about taking smart steps now to get lower taxes, more flexibility, and way more control over your own money. So, what's in the proactive playbook? Well, here are some of the key tools. You've got partial Roth conversions to create tax-free income down the road. If you're charitably inclined, there are qualified charitable distributions, or QCDs. And there are also some specific types of annuities, like KULACs or those with GLWBs, that are engineered to help solve this exact problem.
Let's just take a quick look at one of those, the QLAC. Here's how it works. Right before your RMDs start, you can move a portion of your IRA, up to $210,000, into this special annuity. That money is then excluded from your RMD calculation for more than a decade. That means lower required withdrawals and lower taxes. Then, later in life, say at age 85, it flips a switch and turns into a guaranteed income stream you can never outlive.
As you can probably see, these are not simple do-it-yourself solutions. Choosing the right strategy, or maybe the right combination of strategies, really takes a personalized plan. And that's the most important thing to remember. Your situation is completely unique. The perfect plan for your friend or neighbor might be the absolute wrong plan for you. It all depends on your IRA balance, your other income sources, your health, your goals. This is really where getting some expert guidance can make all the difference.
So the key takeaway here is simple. Don't let a common assumption about RMDs lead to a very costly mistake. Planning ahead is everything. If you want to explore these strategies and figure out which ones might fit your unique situation, the annuity expert can help you compare all the options out there. Our services are always completely free. You can reach us at 770-755-1565 or visit us online at annuityexpertadvice.com. Thanks for tuning in.